Hello friends, welcome to today's session. This is your Renu ma'am here, back with the second part of the session related to basic accounting terms. In today's session, we will be learning some more basic accounting terms. Let us continue with the same example. Those who have not seen the previous video, please do watch that video to learn about the basic accounting terms which have already been discussed in that video. In the previous video, we had discussed about and learned about 10 accounting terms. In today's session, we'll be learning some more basic accounting terms. So let us start today's session. First, let us go through the example once. Miss Smita started business of sale of ready-made garments for children with a capital of rupees 10 lakh. She spent rupees 1 lakh on furnishing the interiors, rupees 50,000 on purchase of a computer. She purchased from Ravi Garments worth rupees 1 lakh and for cash for rupees 1,25,000. She sold garments costing rupees 1,50,000 for rupees 2 lakh for cash and rupees 50,000 worth goods to Sheetal for rupees 60,000. Goods worth rupees 10,000, the cost of which was 7,000, were returned by customers. These were returned back to the supplier for being defective. As business progressed, she decided to deal in ladies' ready-made garments and she introduced additional capital of rupees 2 lakh. She made further purchases from Ramesh for rupees 1,50,000 and for cash rupees 60,000. She sold goods costing rupees 1 lakh for rupees 1,30,000 at a discount of rupees 3,000. The customer was further allowed a discount of 2,000 for paying the dues early. She had paid to her employee salary of rupees 44,000 and rupees 4,000 was still payable. She paid rent of 65,000, out of which rupees 5,000 was related to rent of the next year. She withdrew rupees 25,000 for personal use and took home some ready-made dresses for her personal use worth rupees 3,000. Using this, we learned in the previous session around 10 accounting terms related to the proprietor, capital, purchase, purchase return, sales, sales return. And now, in today's session, we will start with the term revenue. So the first term for today is revenue. What do you mean by revenue? Revenue refers to those inflows that are found in the business which are results of. So inflows which are resulting from either sales, as in our example, Smita is in the business of selling ready-made garments. So sales is the source from which she is going to have inflows into the business, or rendering of services in the ordinary course of business. So whatever are the inflows which come into the business because of the activities which are carried on by the proprietor in the ordinary course of business, in the process of doing business, something is flowing into the business, that we refer to as revenue. Like in our example, selling the ready-made garments which is purchased to her customer will result in an inflow. There will be money flowing into the business, and that is because of the sales that she has done during the year in the normal course of her business. So that amounts to revenue. The second term that we'll learn today is expenses. What do you mean by expenses? Expenses refers to the cost incurred for generating revenue. Now, what do you mean by this? Now, in order to earn this revenue so that she is able to make the sales and get inflows into a business, that is revenue, she will have to incur certain cost, like she will have to make purchases, which is also an expense in a way, without which she cannot sell. Other than that, she has to incur additional expenses. Like in an example, she had to pay salary to her employee. Without an employee, she will not be able to carry on her business. She needs an employee to assist her in selling the goods. Rent is another example of expense which Smita has to incur so that she has a place of business where she can carry on her business. So she has rented out a property where she has her showroom. So rent is an expense which she has incurred so that she is able to carry on business and generate revenue from that business. Now, expenses. Further, you can say that expense, the benefit of these expenses, whatever is being incurred, that would be available only for that particular accounting year. So the benefit expires in that accounting year. What do we mean by this? In the year in which it is incurred, the benefit would expire in that particular accounting year. Means like you pay rent for the, Smita is paying rent for that particular showroom where she is carrying on business. So she is allowed to use that particular place as a place of business for the month when she is paid rent. After that, to continue using that place, she will have to pay regularly rent. So for the amount of rent she has paid for a month, she gets a benefit of using that particular showroom for that particular month for which she has paid. Thereafter, the benefit gets exhausted and then she has to again pay rent so that she can continue using it. Therefore, the benefit which arises from the cost which is incurred would get expired within a particular accounting year. It will not extend beyond accounting year. Similarly, if you take salary, she pays salary to an employee. The employee will work for the month for which salary is paid. Thereafter, if she wants the service of the employee, she'll have to regularly pay salary, and therefore the benefit of employing a person and getting his efforts into the business, she has to keep continuing paying salary. So that is an example of expense which the benefit from which would get expired in a particular accounting year. It will not extend beyond an accounting year. That is what is expenses. The third term that we will learn today is profit. What do you mean by profit? Profit refers to income which is earned by the business. What was income earned by the business from its operating activities. So what is the operating activity? Operating activity refers to principal revenue generating activity. Like in our example, Smita's main activity is buying ready-made garments, adding a profit margin and selling it to her customers. So her revenue generating activity is selling of the ready-made garments which she has purchased. So the income which is earned by her by carrying on this activity is called as profit. Now basically from the revenue, when you remove off the expenses that is incurred, you will get profit. Profits are of two types you can find. One is called as gross profit, and the other one that you will come across is called as net profit. What is gross profit and what is net profit? Now, when we want to ascertain gross profit, you'll be learning in later chapters when we learn about preparation of trading and profit and loss account. The distinction would be more clear, but gross profit refers to the difference between revenue and direct cost. So whatever is the expenses which have been incurred for the purpose of generating that revenue, which are direct in nature, when we subtract those direct costs from the revenue, that is from, in this example, sales, to get that sales, whatever direct cost is incurred, that when you subtract, you get gross profit. Now, what is net profit then? Net profit is when we deduct the total expense from the total revenue. So from the total revenue, that is from the sale of ready-made garments, if total of all the expenses which have been incurred in the business during the year is subtracted, you would get net profit, which means in case of gross profit, we deduct only the direct cost. That is, in this case, we have the cost of purchase. Cost of goods sold will be subtracted from the revenue to get gross profit. But when we are talking about net profit, the total expense here would include the salary which is paid to the employee, the rent which is paid for the building also would be subtracted. And once that total expense subtracted from the total revenue, the amount that you arrive at is called as the net profit. So this is about the term profit. Now moving further, let us go and understand fourth basic accounting term for today, that is expenditure. Now just now we saw about the term expenses, where we said expenses are cost incurred for generating the revenue, the benefit of which expires in that particular accounting period. The benefit you get in the same accounting period. Now, what do you mean by expenditure? How is it different? Now, expenditure refers to the amounts spent or liability incurred in acquiring goods, assets, or services. So expenditure is a wider term here. The amount is being spent, either it is being spent by way of outflow of cash or bank balance, or it might be creation of liability, that is payment is going to be made at a later date, but it is incurred for the following purpose. It can be for acquiring goods, that is in our example, Smitha is acquiring, she is purchasing ready-made garments to be sold to her customer. So that goods also is covered under expenditure. Acquiring of assets, like she has acquired computer, that is also an expenditure of the business. Or services, she might avail services for the purpose of business, some services. So that amount which is spent or the liability incurred for any of these three purposes would be classified as expenditure. Expenditure is a wider term compared to expenses. There are three types of expenditures. The three types of expenditures are, first one we'll take for discussion is revenue expenditure. Now, what do we mean by revenue expenditure? The revenue expenditure refers to those expenditure, the benefit of which is consumed in same accounting year. Like in our example of Smitha, she paid salary to an employee, rent for the showroom. All these are examples of revenue expenditure that she incurred. She has incurred the expenditure and she has used the benefit out of incurring that expenditure in the same accounting year. That is revenue expenditure. This type of expenditure would be debited to the statement of profit and loss account of the business. So it would be charged against the revenue earned during the particular accounting year. second type of expenditure that we will be discussing is called as capital expenditure. So, capital expenditure refers to the expenditures which are incurred to acquire assets. So, like in our case, Smita acquired computer, which is an asset. She incurred an expenditure to create an asset. So that type of expenditure is a capital expenditure, the benefit of which is going to accrue to her over a long period of time. So benefit from such expenditure is available for more than one accounting year. She can use that particular computer that she has purchased for many more years to come. It is not going to get exhausted in a 1 year and she's not going to dispose of to buy other one. She's going to use it continuously in a business as long as it is working well. So it is a capital expenditure that she has incurred. Even we said here that acquiring, as per this example, she acquired computer, she invested in furniture fitting. Both are examples of capital expenditure. But capital expenditure also includes the expenses which are incurred that enhances the capacity of an asset, of an existing asset. Suppose, deviating from the current example, in case the business was a manufacturing business and there was machineries purchased and installed already and being used. But in this current accounting year, if some other component has been purchased, which when added to the current existing machinery would increase the capability or capacity of the existing machine to be able to produce more number of units than before, more number of output than before, then that enhances the capacity of the existing asset. So whatever is the expense incurred in purchasing that additional component which got attached to the existing asset of machinery is also classified under capital expenditure. Now these type of expenditures which are incurred, which are called as capital expenditure, that would be shown in the balance sheet on the asset side. And it can be on the basis of asset we have already discussed in previous. It can be a tangible asset like in the case of our example, computer, furniture and fitting, both tangible asset, or it can be in the form of intangible asset. Suppose she purchased computer software. Computer software is an intangible asset which cannot be seen or touched, but still it is an asset. It enhances the capability of the computer and helps the computer to operate in a proper manner as is required. So that is another example of capital expenditure. Now moving further, the third type of expenditure that we have is called as deferred revenue expenditure. Now what is deferred revenue expenditure? From the term only we can see that it is having the term revenue expenditure. So basically it is a revenue expenditure. But there is a little deviation in this. Normally revenue expenditure, as we said, the benefit of such expenditure is used up in the same accounting year in which it is incurred. But deferred revenue expenditure is a type of revenue expenditure, the benefit of which extends over more than one accounting year. So what do we mean by this? Now for example, deviating again from the current example, And a very good example of deferred revenue expenditure would be advertisement expenditure. So you would see that when a new product is being launched in the market, you normally find back-to-back advertisement coming in every channel every few minutes. You know, the advertisement cost of advertising like this back-to-back is quite huge. So huge advertisement cost is being incurred. But advertisement is normally treated as a revenue expenditure, you will get the benefit. But this advertisement expenditure being huge amount being spent, the benefit of this in the form of sales is going to accrue over more than that particular one single accounting year. So more than an accounting year, like you can expect the sales to be there for next probably 3 years. So it would assure that because of this advertisement, people are going to get used to this particular product. They're going to come back and keep purchasing the product once they start using it for next at least 3 years. Therefore, you find that this expenditure is going to give benefit not for just one accounting year, but for next 3 years. Therefore, it would be logical to say that this expenditure should also be written off over 3 years. It should not be written off in the same year. So, it is necessary that such expenditures be written off over its useful estimated life. Estimated years when benefits are going to accrue from it. Like in my example, I said because of huge advertising, if the benefit is going to come in the form of increased assured sale for next 3 years, then it has to be written off over next 3 years. And therefore, whatever is written off, the written off portion would be debited to the statement of profit and loss account, and the rest of the amount which is still to be written off would be shown on the asset side of the balance sheet till it is written off. Every year to be written off, and by the end of 3 years it would come down to nil, and therefore every year portion of that expenditure is charged against the profit of the year in which the benefit is likely to accrue. So this is about deferred revenue expenditure. It is basically a fictitious asset. An asset which is not really an asset, but still it is shown on the asset side of the balance sheet because it is going to give some sort of benefit which we are charging over different accounting years. So this is about the 3 types of expenditures. Now moving further, having understood about expenses and expenditures, now we have the next term that we need to understand, that is outstanding expense. What do we mean by outstanding expenses? Now in our given example, here we saw that Smita paid to her employee salary of 44,000 and 4,000 was still payable. So she has paid in cash 44,000 and she is supposed to pay 4 more thousand to that employee, but as at the end of the accounting year it is still not being paid. So this 4,000 rupees is the outstanding expenditure that we are talking about. So outstanding expense refers to the expenses incurred which have already been incurred but not paid. So they have been incurred but they have not been paid. So the example here is the salary to employee. Normally salary, how it is paid? A person works for a month, he gets a salary at the end of the beginning of the next month. So for example, March month's salary would be received when? The March month's salary would be received in the say first week of April, and our accounting year is from April to March. So accounting year we are talking about is from April to March. So this March month's salary would be paid in April month, which is the next accounting year. It's going to be paid in next accounting year, but it is for the work which was done by the employee in the month of March. So it is an expense of the current accounting year, but being paid later. So this is an expense which has been incurred, which has to be paid, but only paid at a later date. And therefore, these outstanding expenses are to be added to the relevant expense. So, in our example, the salary of 4,000 which was still to be paid would be paid in the next month. But in the accounting year, when salary is debited to profit and loss account, we should write 44 and outstanding 4,000. So totally 48,000 should be the expense in terms of salary to be charged to the profit and loss account. And the second place where it will be shown is because it has not been still paid. As at the end of March, it has not been paid. It is a liability of the business. So in the balance sheet, the amount of outstanding expense in this example of 4,000 rupees will be shown as liability, and a liability it is a current liability. The liability which is payable immediately at the earliest. So this is the accounting treatment of outstanding expenses. So I hope this is clear. Now moving further, the next type of expense that we'll be learning is prepaid expenses. Now going back to our example, we see that she paid a rent of 65,000. So she has already paid 65,000. There's outflow of 65,000, out of which rupees 5,000 was related to rent of next year. So for next year rent 5,000, she has already paid this year. So this is an example of prepaid expense. So expenses which are paid in advance for the next accounting year is called as prepaid expense. Like for example, in our example of Smita, she has paid rent which is for related to next year, which has been paid now only. So that rent is related to next year. It should not be included in the current year's rent. So what we'll do, we will deduct the prepaid expense because it is related to next year. It should be charged to profit and loss account in the next year against the revenue. So we have to remove that. From 65,000 we have to remove the 5,000, and rest of 60,000 only is related to the current year rent. And this prepaid expense has been paid in advance related to next year. So for the next year, it is an asset of the business as of now because it has been paid in advance. So it will be shown in the balance sheet on the asset side as a current asset. So this is about prepaid expenses. So these are the different types of expenses that you are likely to come across. Now moving further, we'll be learning about the two terms, the term related to discount. Now in our example here, this part, we find that there is discount given. She sold, that is Smita sold goods costing 1 lakh rupees for 1,30,000 at a discount of 3,000. So she has sold it for lesser amount. Instead of getting 1,30,000, she is going to get only 1,27,000. And the customer was further allowed a discount of rupees 2,000 for paying the dues early. So the customer was given maybe a credit period that he can pay after a week or 10 days or 1 month, but he came back and paid early, and therefore Smita again gave that customer a discount of rupees 2,000. So this is another discount that has been given in this example. So now let us understand the term discount. What is meant by discount? Discount is nothing but reduction in the price of goods or amount paid. That is, in an example, firstly 3,000 was reduced in the price, and secondly 2,000 was collected less. The customer had to pay 2,000 less at the time of settlement of that amount. So both of these are called as discount. Now the discounts are of two types. One is a trade discount. The other one is called as cash discount. What do we mean by these two types of discount? Trade discount is basically reduction in the price of goods, but that is normally done when there is a huge quantity being purchased or the value of the transaction is quite huge. In those circumstances, trade discount is given. Like for example, here, because a customer is purchasing for over 1 lakh rupees worth of goods, probably he might have bargained with Smita saying that as I'm purchasing such a huge quantity and the value is also quite large, give me a reduction in the price. And so she offered a discount of 3,000. So that type of discount which is given is called as trade discount. So in this type of discount, the discount amount is not recorded in the books. The value of the transaction itself is reduced. So value of the transaction which is recorded would be at lesser value. Means instead of recording the discount from that 1,30,000 worth of sales that she made, 3,000 would be reduced and the sales would be recorded at 1,27,000. And for the purchaser, the customer will also record the transaction as 1,27,000. 1,30,000 is not going to be considered at all. Total value of the transaction only would be treated as 1,27,000. So when it is a trade discount, it does not come into the books of accounts at all. The reduced value will come of the transaction would come into the books. That is trade discount. So at the net value it is going to be recorded. Next is the cash discount. When is cash discount allowed? Normally cash discount is allowed for timely or early payment. Now, for example, if the customer was given a credit period of say, okay, pay by a week or 15 days or within a month, and the customer comes back and pays it earlier than the period he was given, then he might say that as I'm paying early, please give me some discount. Now, this type of discount which is given when the amount is being paid, the balance is being settled, that type of discount is called as cash discount. So what happens is, out of the transaction of 1,27,000 which has got recorded, now 2,000 rupees is going to be received less. So transaction was recorded 1,27,000, but amount going to be received is just 1,25,000. Therefore, that 2,000 difference would be put into discount account. For the seller, it would be discount allowed, which would be debited to the profit and loss account, and for the buyer, it would be discount received, which would be credited to. So this is debited and this is credited to the profit and loss account. For the seller, it is an expense. For buyer, it is an income. It's actually a gain because he has to pay lesser amount. And therefore, cash discount is recorded separately in the books of accounts. So normally whatever you find as discount in the books of accounts, it is a cash discount which you are referring to. Trade discount never comes into books. It is deducted from the value of transaction. The net amount, the net value is only getting recorded. So this is all about discount. I hope it is clear. Now moving further, the next accounting term that we are going to discuss today is inventory. So in the previous session, we had discussed the term goods, where we said that all those physical items which are traded, which are purchased so that it is sold off, those are called as goods. Like in our example, Smita's goods are those ready-made garments which she purchases and which she is going to sell at a profit to her customers. So if it is a stationery shop, stationery items that is purchased, kept in the shop and sold are goods. Now, what is inventory? Inventories are those tangible assets. Are tangible assets. They are assets which can be seen and felt, which are held by the business for the purpose of sale in the ordinary course of business. Or for use in manufacturing. So whatever tangible assets which are there, which can be seen and felt, which are being held in the business for the purpose of sale, means like in our example, those ready-made garments which are purchased, they are tangible, you can see, feel it, and therefore they are tangible assets of the business. They are being held by Smita so that in the normal ordinary course of business, in the normal course of activities of the business, she is going to sell it. She is reselling those goods. But if it is a manufacturing concern where cloth is purchased, stitched, and then the ready-made garments are sold, if that is the case, then those cloths which are purchased would account for inventory, because cloth is also tangible. They are held, they are going to be used in the manufacturing of ready-made garments. So both of these are called as inventory, are covered under the term inventory. Now there are two types of inventory that you will come across. One is called as opening inventory and the other one is called as closing inventory. What is opening inventory and closing inventory? It is very simple. Opening inventory is inventory for the stock of material which is held at the beginning of accounting year. Unless it is the first year of business, every business is going to have opening inventory. In the first year of business, there will not be opening inventory. Closing inventory is the inventory which is there at the end of the accounting year. So it is not possible that whatever is the goods purchased during the year, entire goods are sold out as on 31st March, that is the end of the accounting year. It is not possible. Some goods are going to be there in the business, lying there in business unsold, which will be sold in the next accounting year. So those stock of goods that are lying with, in our example with Smita, at the end of her accounting year would be termed as closing inventory. The closing inventory of this particular year will become the opening inventory of the next accounting year. So this is called inventory. There are different kinds of inventory that you can find. Like for example, in our example, these ready-made garments are goods which are held for resale. So they are called as stock in trade. So these are goods purchased so that it is sold at a profit. So that is inventory. If it is a manufacturing concern, as in the example I gave you, if they are purchasing cloth and stitching it and then selling it, then raw material cloth is also part of inventory. It's another kind of inventory. Then there is also something called as work in progress. So in that manufacturing example where cloth is purchased, cut and stitched into ready-made garments and then sold, it is not possible that whatever cloth has been purchased entirely has been stitched and completed at the end of the accounting year. There might be certain pieces of cloth which have been just cut still to be stitched, or which are in the stitching process, which are not completely ready. They are not complete final products yet, not final ready garments to be ready for sale. Then those are classified under the category work in progress, because work is still in progress, it is not completed. And one more you can have is finished goods. That is, in case of the same manufacturing concern, it is possible that goods have been completed, ready-made garments are ready, packed, available, but still they are not yet sold at the end of the year. They might be sold in the beginning of the next accounting year. So that would be classified under the category finished goods. So these are the different kinds of inventory that you will be able to find in the books of a manufacturing concern. And in case of trading concern, you would have the goods in the form of stock in trade. Now, where do we show this inventory? This inventory will be shown in the balance sheet on the asset side as a current asset, because it is going to be moving, it is going to get sold off, it is going to get converted into cash, so it is a current asset. And how do we value such an asset? It is valued at cost or net realizable value, whichever is lower. So this is one of the accounting concept related to inventory, that it will be valued at cost or net realizable value, whichever is lower. As per the prudence and conservatism, it is required that you should value whatever is inventory lying with you at its cost or the net realizable value, what value you will realize after deducting the expenses. If you are able to sell it immediately, that is a net realizable value. Whichever is lower, at that value you should value and put it in the asset side of the balance sheet. So this is all about the term inventory. Now moving further, we'll go to the next accounting term, that is drawings. In our example, going back to it, we saw that she withdrew rupees 25,000 for personal use and took home some ready-made dresses for her personal use worth 3,000. So this is called as drawings. So what is drawings? The cash or the goods which are withdrawn for personal use of the business person. It can be a proprietor in case it is a proprietary concern, or in case of partnership firm, it is a partner. So the drawings are nothing but withdrawals for personal use. It can be of two types. It can be cash being withdrawn for personal use, or it can be goods which is withdrawn out of the business. Like in our example, she withdrew around 25,000 for her personal use. So she has to incur some expenditure. She has to pay the rent of her house where she lives. That will not come into the books of accounts of the business because it is her personal residence. For that, what is being paid is for her personal use. It is not a business expense. So it should not come into the profit and loss account. It is for personal use, so it is going to be shown as drawings. And in the example, she also withdrew goods worth 3,000 for her personal ready-made garments for personal use. She took some ready-made garments home for personal use. So that is also to be valued at cost and treated as drawings. So we are basically telling here that the business and the owner here has separate identity. They are two different. Business is different from the owner. We are going to separate them. And we say that anything for the personal purposes of owner would be treated as drawings. So all these items, whether it's cash or goods, that would be debited to the drawings account separately. And then it would be subtracted from the capital. From the capital in the balance sheet. So the balance sheet, when we write capital less drawings, whatever has been withdrawn, it can be cash or goods which is withdrawn, which will be debited to the drawings account, and at the end of the year that amount will be subtracted from the capital in the balance sheet. So the capital is going to go down to the extent of the drawings of the proprietor or the partner of the business. Cash withdrawal, you know, whatever is amount withdrawn. But for the goods that is withdrawn, the value of the drawing, how will you value it? It is valued at cost. So whatever was the cost incurred to purchase that goods when it was purchased for business, at that value will put the amount of goods withdrawn as drawing. Suppose amount paid for that goods is 3,000, then 3,000 is the amount of drawings. You will not take the sale value. If it is sold, what amount will be realized will not be taken into consideration. The amount which has been incurred as cost, as an expense in purchasing that, would be the value at which you debit it to the drawings account. Finally, the last term that we'll be learning today is voucher. What do you mean by voucher? Voucher is an evidence of a business transaction. So we know that we have learned that in accounting, all the transactions get recorded in the books of accounts. So transactions are those events which have money or monetary value to it. Now, how do we record those transactions? On what basis do we record those transactions? It is these vouchers that are available, which is referred to, and using that the entries are passed in the books of accounts. So vouchers are basically those evidence which are available related to business transaction. You will find these vouchers in different forms. Like you would have seen when you go to buy something, you ask for the bill. So the different terms that are used are bill. You will see on the top written bill, cash memo, or invoice, or even receipt. So these are the different terms in which you will find that normal thing that we call as bill. So that is the evidence of the transaction, and using that entries are passed in the books of accounts. From that we will be able to ascertain what is a transaction, why it is incurred, where it should go, and at what value we are going to record it. So voucher is basically a very important evidence which helps in knowing the business transaction, the details about the business transaction. So these are the 10 accounting terms that we have learned today. Now let us just try to understand using the example how to calculate certain amounts. Before concluding sessions, we will learn about calculation of different amounts using the basic accounting terms and using that example. Now, the different terms that we are going to learn today. Calculation of is, first is capital. What is the capital which has been introduced by Smitha. You find Smitha started business of ready-made garments for children with the capital of rupees 10 lakh. And thereafter you find that as the business progressed, she decided to deal in ladies' ready-made garments and she introduced additional capital of 2 lakh. So totally, she has invested how much? 10 plus 2, 2 lakh, 12 lakh. So 10 lakh plus rupees 2 lakh is the amount of capital she has introduced during the year. And then we saw just now about drawings. What is the amount of drawings? We found that she withdrew 25,000 rupees for personal use and took home some ready-made garments for her personal use worth 3,000. So goods worth 3,000 and cash worth 25,000. So the total amount of drawings is rupees 25,000, which is in cash withdrawal, and rupees 3,000 in the form of goods she has withdrawn. So total amount 28,000 rupees is the amount of her drawings. This would be deducted in the balance sheet from her capital. Moving further, let us understand what would be the assets that would appear in her balance sheet. Now, the assets that are going to appear in her balance sheet are, we find that she spent 1,000 on furnishing the interiors, which is the furniture and fittings, and 5,000 on computer, 50,000 on the computer. So, the assets that are going to come into her books are, 1, you have the furniture and fittings, rupees 1 lakh, computers, that is rupees 50,000. Other than that, there is prepaid expenses which she paid. The prepaid rent of rupees 5,000 would come under the current asset, and also there will be inventory which will be valued at cost or market value, which is lower. At whatever value, we will take cost or market value, or we'll say the net realizable value, whichever is lower. So these are the different items of assets. Out of these are tangible fixed assets, and these two are current assets of the business. Now moving further, we will take the term purchase and see what is the total amount of purchase. If we go back to the example, we find that she purchased from Ravi garments worth 1 lakh. Then she sold garments, and then goods worth 7,000 cost were returned by the customers. These were returned back to supplier for being defective. So it will be returned at 7,000. Thereafter, as the business progressed, she introduced capital, and then she made further purchase from Ramesh. So there is cash purchase of 1,25,000 from Ramesh. This is a credit purchase, and for cash 60,000. So these are the different purchases. There's a purchase from Ravi for 1 lakh, cash 1,25,000. Again, credit purchase from Ramesh 1,50,000, cash purchase of 60,000, and there is a purchase return. So let us note this down and see what is the total amount of purchase. So we'll take Ravi. So it's a credit purchase of rupees 1 lakh. At the same time, cash purchase also was there of 1,25,000. At the later date, there was a credit purchase from Ramesh, which was 1,50,000, and there was a cash purchase of 60,000. So we total it up, that comes to 4,35,000. And there is a purchase return, which was the goods returned by the customer, which was returned back, the cost of which was 7,000. So that is debited to purchase return. Then that purchase return would be deducted from this purchases amount, and the net purchase will be taken in the trading account. Moving further, next we will learn the fifth is the sales. Let us calculate the sales. Look at the example. Here, if you see, she sold garments costing 1,50,000. This costing will be helpful in valuation of inventory to know what is the cost of the goods sold. But it's sold for 2,00,000 for cash, and rupees 50,000 worth goods to Sheetal for 60. So sales 2,00,000, cash 60,000, credit sale. And then further, as the business progressed, she sold goods costing 1,00,000 for 1,30,000, but there was a discount, trade discount given here. So these are the items. Cash sale of 2,00,000, credit sale of 60, again cash sale of 1,30,000 but less trade discount, so 1,27,000. And then you should also remember there was a sales return. Goods worth rupees 10,000 were returned by customers. So this is a sales return. So going to the sales, we had cash sales of rupees 2,00,000. The sale value was 2,00,000. Then there was a credit sale which is done to Sheetal, which was rupees 60,000. And then again there was a cash purchase, but here although the value was 1,30,000, there was a trade discount given at the time of sale of 3,000, which would be subtracted, and the sale value of 1,27,000 only gets recorded in the book. So totally the sale was worth 3,87,000, and there was a sales return. The customer returned goods worth rupees 10,000. So when we write sales, in the inner column we will subtract the sales return and take the net sales of 3,77,000 in the outer column. So this is how we will be calculating sales. The next item that we will learn to calculate is expenses. Now here we know salary to employee was paid, which was 44,000, and 4,000 was still outstanding, but still being the expense of the year. If you remember the explanation of outstanding expenses included, added to the relevant expense. So totally 48,000 is the salary expense. When it came to rent, we saw that 65,000 was paid, but 5,000 of that was prepaid rent related to the next accounting year. So actually related to current year it is only 60,000. Other than that, we have one more, that is discount allowed to the customer. That is when he came to pay, 2,000 was the discount allowed to the customer for paying early. So totally you have 1,10,000 would be the expense of the year. So from this we understand the expenses total is 1,10,000. The next is the term outstanding expense that we learned. So in the outstanding expense, the amount related in this example is only the salary of rupees 4,000, which was still to be paid, is the outstanding expense. And prepaid expense in this example is related to the rent rupees 5,000 which has been paid in advance. So these are the calculations how we go about calculating different items related to this particular example. So I hope today's session was useful to you all. If you liked it, please do like, share and subscribe to my channel. Stay tuned for more videos. Have a great day. Thank you.